Today's video will focus on how to use JEPI, the JPMorgan Equity Premium Income ETF, in a portfolio. Unlike most investment channels out there, this one is run by two experienced investment professionals who used to show portfolio managers at Morgan Stanley and Merrill Lynch how to evaluate funds and build portfolios. Today, I'm going to show you how to do that with JEPI, also called JEPI in the industry. We'll start with a brief overview of what JEPI is and how it's managed, then get into how it can be expected to perform in different market environments, which kinds of investors should and should not consider it, and how it can complement other strategies in an investor's portfolio. Let's dive in. At its most basic level, JEPI is a US equity covered call ETF. What's a covered call ETF? In a nutshell, it buys stocks, then writes or sells call options on them. A call option gives the buyer the right to buy a stock at a set price. Of course, they'd only want to do that if the stock goes higher than that price. So if you're selling those options, like JEPI is, that means someone else gets to benefit from the upside in the stocks if they go up a lot. So to recap, JEPI buys stocks, then sells call options on them. That means you get a little of the upside potential. But then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A juicy yield. And that is the main reason people buy ETFs like JEPI. Right now, it's yielding almost 8%. Now that you've got the basics down, let's dive a little deeper into how JEPI is managed, since it differs from the typical cover call ETF in a few important ways. First of all, JEPI is actively managed. It starts with the stocks in the S&P 500, but rather than try to mimic the index, the portfolio managers basically try to create a lower risk version of it. That's important because if you're going to give up the upside potential, you want to also be protected on the downside. For example, they have limits on how much can be in any one sector or company. That helps lower the risk because the more exposed you are to one thing, the more at risk you are if something goes wrong with it. If, say, interest rates go up, or there's a new wave of tech regulations, or a trade war impacts the supply of key materials for tech companies, that would likely have a more negative impact on the overall S&P 500 than JEPI's portfolio, since the S&P is more concentrated in tech stocks. Even if it's not tech-led, JEPI should lose less than the S&P 500 in most stock market downturns for two reasons. The income from its covered calls will help offset some of the losses, and it also owns a lot more defensive stocks than the S&P 500. However, this brings us to an important distinction that we're going to talk about throughout the video. It offers downside protection compared to the S&P 500, but to say something like this is just crazy.
It might be an okay option versus like a fixed income fund.
Let me be clear. JEPI is in no way an alternative to a fixed income fund. Yes, they both pay income, but they're vastly different. Bonds generally have low or even negative correlation with stocks. To put it simply, that means that usually when the stock market is going down, bonds are going up. 2022 was an anomaly. JEPI may be invested in less volatile stocks than the S&P 500, but it's still invested in stocks. If the stock market is down, JEPI will most likely also be down. For a retiree who's got some stocks for growth and some bonds for stability and income, JEPI would be a very dangerous alternative to bonds. What makes that stock and bond portfolio work is that the bonds are usually going up while the stocks are going down. If the part of your portfolio that's meant to protect you in downturns is also going down, it's not going to do a very good job of that. Let me show you how this works. I'm going to use the mutual fund version of JEPI, JEPI-X, since its track record goes back a little further. But just so you can see, it's essentially the same as JEPI. Let's start by looking at the stock market correction in the fourth quarter of 2018. SPY, which I'm using to represent the S&P 500 in red, fell almost 14%. JEPI-X fell less, a little over 8%, but it definitely still fell. By contrast, BND, the Vanguard Total Bond Market Index, rose almost 2%. It was a similar pattern when the market fell in May 2019, July to August 2019, and September to October 2019. The most important period to look at, though, is the downturn in early 2020. When the S&P 500 fell broadly and rapidly, JEPI-X hardly provided any downside protection. BND outpaced it by over 30%. Every downturn is different, but these periods are like blueprints for what to expect in most of them. JEPI is not a bond fund or anything like it. It's a stock fund. If we have a narrow downturn led by a particular sector, especially if it's tech, JEPI should hold up better than the stock market because it's less concentrated in tech. If we have a gradual downturn, it should hold up better than the market because the option income can help provide a cushion. But that takes time. Let's say it yields 8% in a year, which would be about 0.67% per month. If the market gradually falls 12% in a year, that 8% cushion is pretty nice. But if it falls 12% in a month, you only get 0.67% cushion from the call options, and that probably doesn't make you feel much better. In any downturn that's not driven by rising rates, most bonds should hold up significantly better than JPI and the S&P 500. The reason they often go up when the stock market is going down is because when people are scared, they rush to safety. In investment terms, safety often means safe assets like treasury bonds. That buying activity pushes up the prices of bonds at precisely the time when selling activity is pushing down the prices of stocks. If we get a recession and the Fed lowers interest rates, that just further boosts the return on bonds. 2022 was the rare type of downturn when JPI offered better downside protection than bonds. First, it was gradual. Second, it was narrow and driven by tech stocks. Third, the downturn was partially caused by rising interest rates, so bonds didn't hold up well. Actually, I believe it was the worst year of all time for bonds. It was a perfect storm. And since that's the only major downturn JPI has been around for, I fear a lot of novice investors are developing unrealistic expectations for it. This could happen again, but it's very unlikely. And I would strongly caution anyone against thinking this is an alternative to bonds. To recap, in most down markets, I would expect JPI to lose less than the S&P 500, but more than bonds. In up markets, it should beat bonds, but lose to the S&P 500. In the long run, I think it's also very likely to lose to the S&P 500. Here are all the US covered call ETFs and mutual funds with a 10-year track record I was able to find. Every single one of them got smashed by the S&P 500 over the past 10 years. And that should surprise no one. Selling covered calls limits the upside potential of JPI and any other strategy that uses them. In JPI in particular, they usually set the covered calls to cap the appreciation potential at about 2% per month. And how often does the S&P 500 go up over 2% in a month? More often than you think. On average, about 5 months out of every year over the past 10 years. But here's the real kicker. As of the end of February 2024, the 10-year return on the S&P 500 was 12.7% per year. Do you know what it would have been if you'd missed out on all the returns above 2% in each month? Negative 2.2%. You actually would have lost money if you'd capped your monthly return at 2%. The paradox with covered call ETFs is that the income is higher when volatility is higher. Everyone wants that high income, but when volatility is higher, it also means there's more extreme returns in the market, bigger up months and bigger down months. That means more of the long-term return comes from short-term rallies, and more of it will be missed by covered call ETFs. It also means bigger losses in the bad times. You capture most of the downside and miss out on most of the upside. It's not a good deal for most investors in the long run. The only market when I'd expect a covered call ETF like JPI to beat the market would be in a relatively flat market. And how often does that happen? Almost never over a long period of time. JPI does a better job than most covered call ETFs in building a low volatility portfolio to reduce those extremes, but it can't avoid them completely. Even with the high income payment, it's just simply not enough to compensate for the return you're giving up. Since inception in 2020, JPI has trailed SPY by about 25%, even after all the income it paid out. So, who should consider JPI in a portfolio? Almost no one, in my opinion. Someone recently asked me, don't you want at least one covered call ETF for constant monthly income, even if you're a young investor? In my opinion, you don't. Because when you're a young investor with a long time horizon, the most important thing is long-term growth. With ETFs like JPI, you're sacrificing a lot of the long-term growth for income that you probably don't need. Lots of people also suggest using JPI in an IRA since it's tax advantaged. The thought process here is that since JPI uses equity-linked notes for its covered call exposure, which makes them less tax efficient, it will be better to hold it in a tax-advantaged account. That's true, but it still comes back to whether JPI is the best option for you to accomplish your objectives. If you're young and have a lot of time before retirement, it's not likely to do as well as a pure equity fund without covered calls. If you're in retirement and taking income, then it starts to make a little more sense. That's the case regardless of whether it's in an IRA or not. However, volatility is also really important to consider in retirement. And JPI is still a stock fund subject to stock market volatility. Yes, it'll be less most of the time, but it is not like a bond fund, as we discussed earlier. And remember, in a short, rapid downturn like 2020, it may not protect you from losses much at all. The future is uncertain, but these are the risks that are important to consider when making investment decisions. Being blinded by the income and forgetting to consider the downside risk is a recipe for disaster. Where I think JPI can make sense in a portfolio is for investors who need a high income, don't need much long-term growth, and want to use this as a lower risk portion of their equity allocation. I know I've said this before, but in my opinion, JPI is not a replacement for bond funds. I'm emphasizing this because I know a lot of investors use it that way, and I fear they could be in for a rude awakening. So it can make sense for some investors, but personally, I am not a fan of most covered call ETFs. I think giving up most of your upside potential and keeping most of your downside potential is not a good deal for investors in the long run. Even for retirees that want to generate income, I think there are better ways to go about it. Instead of worrying about how much income your investments pay out, you can just reinvest all the dividends and capital gains and then set up a systematic withdrawal plan. It's very easy to do on any brokerage account, and then you can get a stable monthly income payment that feels a lot more like the regular paychecks you used to get when you were working. Why go through all the extra headache of picking funds based on their yield, worrying about how much income you're going to receive each month, and settling for options like covered call ETFs that require unsavory trade-offs? Think about it this way. $1 in your account can be turned into $1 of income. It doesn't have to come from a dividend or interest payment. In fact, it will be a lot more tax efficient to avoid funds like JEPI and get more of your return from qualified dividends and long-term capital gains, aka stocks. Bonds can be used to lower the volatility of your portfolio, which will help you sustain those income payments over time. As you get into retirement, your time horizon gets shorter, and you no longer have a salary coming in, so volatility becomes more and more important to consider. It's simple math. If your portfolio goes down 10%, you don't just have to make 10% to get back to even. You have to make 11.1%. If your portfolio goes down 50%, you don't just have to make 50 or 51% to get back to even. You have to make 100%. Each extra percent of losses takes even more to recover. And if you're taking income from your portfolio, it's even harder to make up for a bad year. So my preferred retirement income approach for retirees has 3 elements. The focus should be on building a solid portfolio with 1, enough growth to sustain your income, 2, low enough volatility to avoid huge losses, and 3, a systematic withdrawal plan to smooth out your monthly income. In my opinion, covered call ETFs like JPI take too much of your long-term returns away and leave you with too much of the short-term risk to be a good option for most investors. The main advantage is the income stream, but you can actually create a more stable income stream with fewer trade-offs and better tax efficiency with the approach I just described. If it were me, that's how I'd do it. If this is your first time here, I'm Kyle with Fundamentals of Finance, and if you want to continue the conversation, I do have a link below in the description to my free Discord. If you don't know, a Discord is like a Facebook group. So if you want to interact with me and other people that watch my channel and ask more questions and things like that, join the free Discord below. Also, let me know any other funds you want me to cover, and I'd be happy to do a video on it. Thanks for watching, and I'll see you in the next video.